everyone, welcome to Money Rebel.
Money Rebel!
Money Rebel. So today we are going back to basics. This is the first in our series of investing for beginners, where we're really taking you through the journey of like what are all the things you need to know as a beginner investor. So what's the plan for today, Cameron?
So today we're going to be looking at why you should invest in the market for the long term. So why are we long-term investors?
Yeah, that's a good one.
And we're also going to unpack a few other things. We're going to talk about what a stock and share is. We're going to talk about what compounding interest is. And we're also, as a bonus, going to introduce you to the Yoda of investing.
Ooh, who's the Yoda?
Wow, you have to watch on to find out, don't you?
So the first thing we're going to talk about is what is a stock and a share? And is a stock and the share the same thing?
Wow.
Wow.
There is an answer to that. And the answer is yes.
In a word, yes.
There you go.
So when you own a stock or a share, you own an actual share in a company. So if I own a share in Apple, that means I own a part of Apple. And when Apple makes revenues, I get a part of that revenue in the form of a dividend. So that's great. Every time you buy an iPhone, you buy, I nearly said iPod, which is really old. I mean an iPad. Then that's great for me, isn't it? Money goes into my pocket. So when starting out, one thing that we always think about is you need to invest for the long term, and at Money Rebel we're very much long-term investors, because that really gives your money the biggest chance, I guess, to grow.
Yeah, and the reason why it grows is because of something called compounding interest.
Ooh.
Yes. So let's say I give Anna £1,000 and she agrees to pay me 10% interest on that. So, in the first year, I would have my £1,000 plus the 10% interest, which is £100. So I would now have £1,100. Yeah. In the second year, this is where the magic happens. We get the £1,000 and then the 10% interest on that, which is £100. But also the interest that we earned last year also gets interest, which is £100, which is £10.
Exactly.
So I've now got £1,210. And then in the third year, I get the £100 interest back, like normal, but then all the other interest that I've got also gets interest, which is £210, which is another £21, which gives me a total of £1,331. Woo! And this is incredibly powerful over the long term. For example, there's the Yoda of investing, Warren Buffett, gives this example. He says, if you put £1,000 into the market in 1942, by today, if you compounded that money and invested all the dividends, remember the dividends is the profits that the companies pay out, how much do you think it'd be worth today?
I don't know.
Okay.
I feel like you know the answer to
I do know
though.
the answer to this. Okay, it'd be worth 40 million today. Yeah, 40 million. So
that's insane. That is actually insane.
Compounding interest is when your money's making money on your money, on your money, on your money, on your money, on your money. But there's another reason why it's important to invest for the long term. And that's because, as you may have learnt from the markets at the moment, the market is very volatile. Yeah. And it can go up and down, swing up and down by quite big amounts sometimes. But if you're a long-term investor, it doesn't matter if the market goes up and down, because the market has always recovered. As long as you believe that the world economy is going to continue to grow, the markets will always grow. So it survived 2 world wars, it survived the financial crash in 2008, it survived the dot-com crash, it survived the Cold War, it survived the coronavirus. Okay, so people always think, oh no, it's crashed, but it always recovers. And I'll put a graph in at this point and just illustrate from looking at the market over time, just how much it recovers. And when you really scroll out, those big crashes that happen like back in the 80s or whatever, they actually end up just little blips on the radar. And so they don't actually really matter. Is the crash at the moment or the downturn in the market going to matter in like 20 years' time? No one's going to be talking about it really because the market would have gone up by then. So that's why we are long-term investors, because it just takes all that risk out of the market.
I think that's really true. So at the moment, I'm fairly new to investing. I've just bought my first shares, and Cam's been helping me choose the shares. It's been really fun. But at the moment, my entire portfolio is down. And I've been like, Cam, I don't think I want to do this anymore. Like, we've had these borderline arguments. I'm like, no, you've just lost all my money. This is really frustrating. But I think it's just keeping that in mind, that actually we are in this for the long term. term, and it's not about, like, in some ways it really doesn't matter that my share portfolio is down right now, as long as you've got confidence in the long term, the longevity of the companies that you've bought and their ability to perform in the long term.
Yeah,
in 20 years you will have forgotten that your shares were down in 2021. So,
yes. So another really key point to make about investing for the long term is that because we need to keep a long-term horizon, we shouldn't put money into the market that we need in the near term. And by that, I mean like for the next 5 years. I always think whatever we put into the market, whenever I'm investing for us, I'm like, can I live without that money for the next 5 years? If the money's yes, then I'm quite happy to put the money into the market and let it do its thing. Otherwise, you shouldn't have anything that if you're saving for a house or you need the money this year, then definitely you shouldn't be putting that money in the stock market. There is one more thing, actually, reason why we should be, what's good about being a long-term investor, and that is because you're a long-term investor, you don't need to worry about checking up on your stocks and shares all the time. I mean, it's fun to do it, but who's got the time to be like keeping track of their stocks and shares all the time? It's like it'd be so time consuming. Just put the money in there and you can just forget about it.
Yeah, which is what I did this week when they all crashed.
That's right.
I'm like, you just stay there, I'm going to ignore you, we've fallen out right now, and then once you bounce back, I'll start checking you again.
Yes, done. That's right.
Boom.
I hope you've enjoyed this video. As I said, we wanted to set out and just explain to you why it's important to be a long-term investor, what stocks and shares are, what compounding interest is, and if you feel like we've done all of that, then please subscribe to our channel, leave a comment, hit the bell so you get to hear when we release.
It means so much to us when we get comments and likes and shares and all of that stuff. So genuinely,
we read the comments.
We definitely read them.
Yeah,
we do.
Exactly. So anyway, we're going to leave it here and tune in for our next one, which is going to be on what you should invest in.
Yes. See you later.
See you later.
Bye.
Be a rebel, be a money rebel, yeah. Be a rebel, be a money rebel, yeah. Do, 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 do.